This is a BC Eagle Finance video. Brigham and Houston Chapter 4 Financial Statement Analysis using Table 4.2 to describe the ratios comprising the DUPONT formula, also known as a company's earning power. As the name implies, the DuPont formula was created by the DuPont Chemical Corporation at the beginning of the 1900s when many companies were merging to form larger conglomerates. DuPont Chemical Company, as you know, makes some famous brands like Kevlar that's used in bulletproof vests for security personnel. They make a product called Great Stuff that comes in cans that you likely saw at Home Depot or Lowe's. You spray this stuff into cracks in your home and it expands to keep out bugs and cold air. They have a brand called Nomex, which is a fire retardant fabric that's used to make firefighters' safety equipment. And then there is the Tyvek brand, which you have seen as you drive along the highway by new construction. The DuPont formula is comprised of three of the ratios that we already know about. The profitability ratio, which is net income divided by sales, the asset turnover ratio, which is sales divided by total assets, and financial leverage, which is the total assets divided by the average shareholder's equity. The purpose of these three ratios is to determine a company's earning power. Earning power, described another way, is comprised of the ability of the company to generate sales, and that's what the asset turnover indicates. How many dollars in sales each dollar of assets contributes. The profitability ratio addresses a company's brand image and cost control. Net income, as you know, is revenue less expenses, and so if you take revenue less expenses, you get the net income. Revenue is the top line. Companies that have a stronger brand image, like Coach and BMW and Coca-Cola, are able to charge more for their products. So, having a higher revenue will produce a higher net income. Revenue less expenses gives you net income, and so if you have less expenses taken from your revenue, that exhibits good cost control. So the profitability ratio, net income over sales, addresses both brand image and cost control. The final ratio, financial leverage, indicates how well the return on assets, the income for every dollar of assets, can be funneled to just the equity part of the balance sheet. You know that the liabilities plus the owner's equity represent financing sources for the assets. If we compare a company's net income to just the dollars that the owners put up, we get a measure of how profitable the return is to the owner's equity. Now, let's look at the DuPont formula, or earning power, for the Allied Food Services Company. Here are the ratios that you've seen before for the Allied Food Service Company, and so we are going to pick three of them. One is the total assets turnover, the second one will be the net profit margin, and the third one will be the equity multiplier. The basics behind the DuPont equation is that the return on equity is the return on assets times the equity multiplier, or financial leverage. Return on assets would be the net profit margin times the total asset turnover. Profit margin, as we've seen before, would be the net income of $117.5 million divided by the $3 billion in sales. That produces a net profit margin of 3.92%, or the company delivers just about 4 cents in profit for every dollar of sales. The total asset turnover would be the sales of $3 billion divided by the company's total assets of $2 billion. $3 billion divided by $2 billion gives you a total asset turnover of 1.5 times, or to interpret it in another way, there's $1.50 in sales for every dollar that the company has invested in assets. And finally, the equity multiplier, or the financial leverage of a company, is the company's total assets divided by just the owner's financing, the total common equity. The total assets would be $2 billion and the total common equity is $940,000. Dividing 940 into 2 billion produces a financial leverage of 2.13 times. In other words, the smart use of debt has increased the company's return on assets, 5.88%, 2.13 times to give the owners a return of 12.52%. That's powerful, and financial leverage is monitored by corporate management as well as investors to see how strategically smart debt can be used to bolster a modest return on assets into a satisfactory return on investment for the owners. To recap, the DuPont formula, or the earning power of the corporation, is comprised of 3 items: the profit margin, ability to generate net income from sales; the ability to generate sales from total assets, the total asset turnover; and the smart use of financial leverage or debt. Thank you for following along.